Welcome to the new series of smart money trading videos. Today's video is about order blocks and identifying optimal entry areas in supply and demand zones. If you find this video helpful, please like and subscribe to our channel. Let's begin with the definition of an order block. An order block is an optimized area of supply and demand. In this context, each order block is considered a supply or demand zone. However, it's possible for a particular supply or demand area not to be classified as an order block. But precisely which area is considered the order block? In a bullish trend, the last bearish candle before the start of a strong upward movement, or the last weak bullish candle before the initiation of a robust upward trend, serves as an order block. And in a bearish trend, the last bullish candle before the start of a strong downtrend movement, or the last weak bearish candle before the initiation of a robust downtrend, serves as an order block. The important point that should always be considered is that order blocks are typically single candle formations, whereas supply and demand zones mostly consist of several candles. When entering a trade, it is these individual order blocks that should be considered, not the entire zone. When the candlestick pattern of an order block forms in a manner where its shadow is equal to or larger than the body of the candle, in such situations, the shadow before the start of the movement is considered as the order block rather than the entire candle. What factors contribute to the creation and significance of an order block? Let's talk about the BOS. BOS, or break of structure, refers to breaking above the previous higher high in a bullish trend and breaking below the previous lower low in a bearish trend. These are the BOSs that determine the strength of an order block, in such a way that if an order block leads to the formation of a BOS, it will be considered a strong order block. And it doesn't matter what pattern the price follows to reach the order block area. It is always possible for the price to quickly change its course upon reaching the order block area and continue its own trend. When the price makes a powerful move with an order block, there is always the possibility that the price will revisit the area of the order block and then continue its trend. This pattern is due to the existence of imbalance. Imbalance means that, due to a sharp move, there was no opportunity for buying or selling transactions, and one of the parties, either the sellers or buyers, has been very dominant, and a trade has not occurred in this area. For this reason, price usually attempts to return to these areas and then continue its trend. Order blocks are categorized into two types, mitigated and unmitigated. Whenever the price reaches an order block area, that area is considered mitigated. An order block that the price has not reached is referred to as unmitigated. But the significance of these two types of order blocks becomes evident when the price reaches an important supply or demand area. In such situations, if you decide to enter a trade, keep in mind that the price often breaks mitigated areas and continues its movement until it reaches unmitigated areas. You can consider unmitigated areas as profit targets in your trades. If the price, upon reaching an unmitigated area, changes its trend direction, we refrain from entering a trade against the trend. How can we use order blocks in our trades? If, based on your trading strategy, you enter a buy or sell trade, always remember to set your take profit before reaching an order block that has formed a BOS. Because there is always the possibility that after reaching this area, the price quickly reverses to its previous trend. Let's continue with the same chart. Always consider strong order blocks as entry areas in your trading that have broken through their previous valid higher highs. There is always the possibility that along the trend, weak order blocks may form. However, these areas often experience breakdown till the price encounters a valid order block, at which point it returns to its own trend. The formation of this order block occurs by breaking through a weaker higher high instead of the main one. This leads to the break of this area and a retracement of the price to the main order block. A very important point. Whenever an order block faces a break, we no longer consider that order block in our trades. This means that order blocks are one-time use. In trading with the smart money techniques, if we intend to set a sell or buy limit order, order blocks are suitable areas for this purpose. Usually, the take profit for these types of trades aligns with a significant supply or demand zone in higher time frames. Therefore, in case of a break at the first order block, the possibility of a reversal from the next order block always exists, and we must always remember that we only have the right to trade when the price has not changed its trend upon reaching a significant supply or demand zone. In this case, there is always the possibility of breaking the order block. In the next video, we will discuss the liquidity, one of the most fundamental and crucial aspects of smart money. Please subscribe and stay tuned with us.